than that, we're going to turn it over now to our presenters and get started. So go ahead, Scott.
All right, great. Thank you. Appreciate that. My name is Scott Phillips. I am the partner in charge of our National Assurance Office. Presenting with me today is Kristen O'Connor and Kellen Garrison, who are also part of our national office. The topics we're going to be covering today are primarily related to what's going to be effective for 12/31/20 year ends. And so that'll be the primary focus. Kellen's has one standard that has portions that are effective this year and portions that are effective next year, but certainly an opportunity to early adopt and maybe an incentive based on kind of when you see that related to some of the consolidation information. The focus primarily, when I say effective for this year, is for our non-public companies. Certainly, the standards are effective for all organizations, but again, primarily the focus here is effective dates for our non-public companies. I'm going to start off talking a little bit about fair value disclosure, some changes that are going to be effective for this next year, as well as at the end, I'll talk about the PPP loans, the CARES Act, some of the accounting struggles that go with that. Kristen's going to cover revenue recognition, both kind of a recap of the standard for those that haven't implemented, as well as some things that we've learned along the way, things that might be implemented for this next year for those that have already adopted, but have run into a few roadblocks or need to make some tweaks and modifications. Then Kellen's got kind of a slew of several other standards that are effective for this year. Again, as Amy said, if you have any questions along the way, feel free to use the Q&A and we'll try to answer those as we go along. All right, so we'll start with financial instruments. And again, primarily this is the fair value disclosure. It seems like when this came out, I think it was around 2007, there's been modifications every couple of years. They revise this and make some refreshes to it and add some things and take some things away. This is applicable to many organizations. Certainly, if you have employee benefit plans, 401ks, 403bs, ESOPs, and even health and welfare, if they've got investment portfolios and whatnot, this is a pretty significant disclosure. Those types of entities, not-for-profits with endowments or significant investment portfolios, this is a significant disclosure area for you. And then also even, in the commercial not-for-profit, the commercial and the for-profit, tend to see less kind of investment type disclosures, but the extent that you have derivatives, swaps, those types of things that are getting fair valued. If there's impairments, and this is kind of a big year for impairments, those are the types of considerations that this disclosure manages. And so some things to think about and to be aware of. So part of this project relates to the FASB. They've been going through all their disclosures. They've actually come up with some disclosure framework in order to determine what's appropriate and necessary for users of financial statements. And so as part of this project, it's not so much a simplification initiative. They have had several simplification initiatives. And sometimes we think when they're done, it wasn't that much simpler, but in any case, with this initiative, it's really looking at disclosures and trying to determine what's the most pertinent to the users, what's the most beneficial, some of the costs and benefits to those disclosures. And so that's kind of the focus of them going through and making some improvements, target improvements to this. I'll put it in three categories, and we'll go through this in the next several slides, but as you look at the three categories related to this particular standard, there are some removals of disclosure elements. There are some modifications to current disclosures. And then they also have some additions, but the additions actually are targeted towards public companies. So if you're a public company, this will be relevant to you, but if you're not a public company, then certainly it's an optional disclosure. You could continue to have it, but not required. And again, we'll go through those in detail here over the next couple of slides. So just to set the playing field, this slide it recaps the standard. There's not anything new in this, but just to kind of we're on the same playing field and starting at the same place, this is where we'll build off of. So we have obviously our recurring fair value investments. Those would be, again, derivatives, investments, those types of things. The non-recurring, which I think is going to be, very pertinent this year, given with COVID and the COVID landscape, there's a lot of impairment activity, particularly when it comes to goodwill, certain assets, long-term assets. So those would be non-recurring that would be triggered by this type of disclosure. And then, of course, we need to think about our leveling, levels 1, 2, and 3. 1 being quoted market price, active market price. 2 being observable inputs, even though it may not be quite as active as a market price. And then 3 being other, we had to come up with our own valuation because there's not enough activity or observable inputs. So we're doing our own valuation or having a third party do a valuation for us. And again, I lay that just as a foundation for some of the changes that we're going to be talking about. Also, in bullet point 4 there, I want to really focus on the word technique. We talk about, having a general description of what the valuation technique is for levels of 2 and 3. We're going to talk about the difference between techniques and processes, because there is some modification to dropping off some of the processes, but that's not the same as the technique. The technique is we use a cash flow, discounted cash flow model. That would be a technique that would still require description in the financial statements. Whereas the process, of how you got there, what are some of the assumptions you used, and some of the underlying data that you obtained in order to do that, some of those descriptions have lightened up a little bit. So the first place we start is, what did they remove? The first thing they removed is that you're no longer required to disclose transfers between 1 and 2. Again, 1 being quoted market prices and 2 being still observable inputs. Either it's in the case of, say, debt securities, bonds, corporate bonds, government bonds, maybe there's less activity there, but still observable activity. And so that's a level 2. Perhaps if there's an impairment, but it's an area where, there's different inputs that you can find for valuation, equipment and those types of things that do have a market. Those would be kind of level 2 type items. So there was a disclosure, there is currently a disclosure requirement that goes away with this, that says if you're going to transfer between 1 and 2, you no longer need to disclose the nature of that transfer. I think that the FASB determined that there wasn't as much value between 1 and 2 because those, again, whether the market's active or less active but still present, or there are observable inputs, there's not as much value in seeing what went from level 1 to level 2. Again, this is transfers. I want to focus on that this is a transfer between those levels, not necessarily a change in your valuation technique. If you change your valuation technique and it goes from 1 to 2 or something like that, that would still require some disclosure. But if you're just going to transfer from 1 to 2 because, it was a debt security that had a lot of trades on it, and then it changed and it had less trades because it became less active, we determined that it really qualified as level 2. Again, that would be the type of disclosure that drops off. Coming to the second bullet point there, this is what I talked about earlier in the previous slide, the technique versus the process. So in the level 3, there's less disclosure requirement as it relates to the process of how you came to that level 3 disclosure. You still need the technique. If it's a discounted cash flow or something like that, you still need to disclose that technique. But as it says there, how often you're revaluing that and some of the changes from period to period and the frequency, some of those types of things. As far as your processes, those things have dropped off. And then as well as the last one, the policy for determining how you determine whether it's going to be a level 1, 2, or 3, the policy requirement goes away. That doesn't mean that the policy goes away. You still have the policy. You need to still have an infrastructure and a framework for how you determine whether it's level 1, 2, or 3, but you don't need to disclose how your policy, your framework. So moving into the next section, again, kind of what was retained and what was added. And I'm going to just clarify right now, and hopefully people don't tune out if I drop to the very last thing, the alert at the very bottom. This is an addition, but it's an addition for public companies. It's not an addition for private. So for the non-public company, you're not required to have this level of disclosure. But for the level 3, which is the unobservable inputs, again, we're having to do some sort of valuation. There's an extensive disclosure requirement if the entity is determining the valuation on their own. So if an entity is doing its own valuation as it relates to, again, if you had a discounted cash flow model, for example, your assumptions and inputs and those types of things are still required. If you look at that first bullet, under retained quantity or quantitative information, there is some exclusions if you have third-party pricing services, because you may or may not have the detail to their models or how they came up with their assumptions. So there's an exemption for those, and that's mostly what I've seen. Occasionally, we do have people that are doing their own organizations that are doing their own valuations, but But for those who are using third-party pricing services, which is pretty common, then some of these disclosure elements are not required. But when you get down to the piece that's added, they want a little bit more information. What are the assumptions? What are the ranges of those assumptions? So if you have discounts, what's the range of discounts that you were considering or evaluating? What are the ranges of some of those inputs, or what is the weighted average points? And so a little bit more disclosure there required, again, for the public companies. Certainly those are optional for non-publics. We do have, non-public companies that feel like they want they benchmark themselves against their peers, and a lot of times they'll do disclosures related to their peer groups that are in the public arena. And so if that's something where you want to make sure you've got some consistency there, that's a place where sometimes we see this. So, or if you have some instruments that trigger you to have to be considered a public business entity, then of course this would be required for you as well. So this is kind of a unique piece. This and the next slide we talk about some changes to the disclosure related to level 3. If you recall now, for your level 3 investments, you're required to do a roll forward of those investments. That roll forward actually goes away, and now we just have a different data point. And this is certainly simplified if you are a non-public entity. If you're a public entity, most of those data points still exist, even though you don't have to do the roll forward. So if you look through here, the gains and losses are required to be disclosed, and particularly as it relates to OCI. So if you have things that are going through other comprehensive income, those need to be disclosed. Again, now it could be in a narrative format. It could just be in part of the sentence. You're also required to disclose the purchases, sales, and issues and settlements. So at the end of the day, you still end up with all the elements of roll forward for a public entity. And again, at the end, the elimination or the transfers have been eliminated. But when you get to, and I'm going to go to the next slide here, this one or the next one, I can't remember. But anyway, one of these slides we talk about for public companies, or for non-public companies, sorry about that. For non-public companies, you're only required to disclose the purchases and the issuance of level 3. So those other elements of the roll forward, the gain, the loss, the sales, that type of activity actually goes away. So you no longer are required to have a roll forward, and you only have to disclose the purchases and the issuance. So again, very limited. So that the roll forward actually has a little bit of gain there in terms of reducing the amount of disclosure that goes on with that. And again, I mentioned this earlier, but if you're in a public company, you're still required to disclose the earnings, the gains and losses, and you have to separately disclose those that relate to anything that ran through other comprehensive income. So that'll be a piece that's a modification for the public companies. One thing that's interesting about this next piece is there's, and formerly, and this is one of those modifications, you had some sensitivity components to that disclosure, and that goes away. But with the new disclosure requirement, there's this, if you look into that new section in the middle of that first sentence, it talks about uncertainty. So now there's an addition, and this is just a narrative paragraph that talks about the uncertainty as it relates to level 3 investments. If you look at the standard, they actually give an illustration example where if there's a mortgage, mortgage-backed securities, and in those, you would have some uncertainty in that mortgage-backed securities if they were in a level 3 portfolio, because within that you have people may be prepaying those investments or prepaying those loans, that loan portfolio that you purchased into. So that would be something that we talk about, the uncertainty related to that. Also, there's default rates that are built into that, and so some uncertainty as it relates to default rates. So if you were to narrate a disclosure, again, the one that's illustrated in the guidance in 2018-13 is, just a narration, a couple of sentences, 3 or 4 sentences in a paragraph that talk about the uncertainty related to prepayment options and some of those types of things, default rates and whatnot. One of the other examples that I thought about as I was doing this is, a lot of times when I'm personally looking at, different clients that have level 3 investments, a lot of times those are in private equities, real estate investments, either in funds or different things like that. And so one of the things I thought about in the current environment in particular is there's some uncertainty as to occupancy rates. So that might be something that you would think about disclosing. Also, future lease rates could vary. But really, I think about those occupancy rates with the COVID environment and lots of leases coming up for renewal over the next year or two. A lot of people have been working from home and reevaluating whether or not they need all the occupancy, all the real estate that they've currently locked into. And so if you've got clients that are, or if you're clients that are, or entities that are invested in, again, these private equities, that could be a place where there may need to be a little bit more disclosure over some of the uncertainty related to those types of investments. This kind of recaps a lot of what we talked about. Again, if I were to just kind of pause and talk about, kind of recap everything we talked about, the removals, the things that they've taken away from the disclosure, again, would be your level 1 and 2 transfers, no longer required to disclose those. The policy for some of your policies related to transfers, no longer need to disclose. Again, you still have those policies, but you wouldn't need to disclose them. The roll forward for level 3 goes away, and then some of your unrealized gains and losses, some of that with that roll forward, those things get modified and taken away. Some of the modifications relate to, again, with level 3 with the roll forward going away, you still need to have purchases and issuances if you are non-public. Most of those elements of the roll forward are still effective for non-publics or for public companies. And then again, with that expanded, with the uncertainty, and then also some of the expanded disclosure, with the additions for public companies related to some of those assumptions. What are your ranges of some of the assumptions you have, discount rates and whatnot? So I think we've hit most of the points in this slide already as we've been talking about this. So with that, I think we're ready for, to talk a little bit about what are the impacts of COVID. And, with COVID this year, certainly there's been significant impact in investment portfolios. Just watching over the, the news over the last couple of days, the third quarter had a huge rebound, which is positive. And so the extent that you're in an investment portfolio that's fair valued, level 1 investments and potentially the level 2s, maybe there's just some recoverability there, and there's some disclosure related to that, some disclosure considerations. If you're in an entity that was significantly impacted by COVID in terms of your operations, then there's some evaluation for whether or not you have impairments this year. Again, goodwill, long-term assets, those types of things. So there may be, maybe you haven't had this type of fair value disclosure before because you haven't had any recurring and any non-recurring, but now this year you're going to have an impairment potentially, or at least the valuation of impairment. And if to the extent that that's recorded, then this would impact that type of a disclosure.
Good morning, everyone. Thank you so much for joining us. I get to talk about everybody's favorite standard, revenue recognition. We're here again at another ANA update, talking about revenue recognition. So this is going to be a high-level overview. We're going to review the 5-step model, and then we'll spend some more time going through the required disclosures. Since there's about half of you that have not implemented yet, that will be a good refresher on how your financial statements are going to be impacted with the addition of this standard. So going back to ASU 2014-09, so revenue from contracts with customers, our original implementation dates were for public companies periods after December 15, 2017, for non-public after 2018. And of course, we had ASU 2020-05 that came out this year that permitted delay. And it looked like a good chunk of the attendees took advantage of that, and so have not yet implemented 606. So we're going to start going through our 5-step model. So this will be a brief refresher on the different elements in order to recognize revenue under this new standard. I will go through just a couple highlights, takeaways for each of these before we jump into disclosures. So 5-step model, our first step, got to identify your contract with a customer. Make sure you have a contract with a customer. Second step, then you're going to go through, identify your performance obligations within that contract. What are you actually doing for the customer? Number 3, determine your transaction price. Then you're going to allocate that transaction price to those performance obligations that you identified. And last but not least, you finally get to recognize some revenue as you satisfy those performance obligations. So as I was taking a look at this 5-step model, I'm a very visual person. I'm sure a lot of you are as well, that I need an acronym. I need something to trigger all of this when you give me a list like this. So I came up with my visual for the 5-step model is my friend C-3PO from Star Wars, the gold droid, drowning in a tar pit, because that seemed, very good for 2020, very representative of the year. So C, contract, PO, performance obligation, C-3PO, tar pit, TAR, transaction price, allocate, recognize revenue. So if you're having a hard time remembering these fun elements, you've got a nice little visual now for you. So step 1, our contract. So as you're looking at the contracts that you have in place, these are the required elements that need to be in there before you can even start thinking about recognizing revenue. So the first is the approval and commitment of all parties. So where this could potentially fall apart is if what you have set up right now really only provides for approval of one side of the agreement, one party. So some examples I saw were like a purchase order. If you don't respond at all, there's no sales confirmation, you have not yet agreed to that agreement to make it a contract. So you need to make sure both parties have some form of approval on the agreement to make it a contract. The contract needs to have some terms within it. We need identification of the parties' rights. It needs to be clear what each person is getting out of this. Also, identification of the payment terms. This agreement should have commercial substance. And then last but not least is collectability. And this is the area that we've seen probably the most time to evaluate whether or not you actually have a contract, because the collectability of the consideration needs to be probable. So there are times where maybe you're entering into agreements with a new customer, you don't have a lot of history with them, it's a high-risk endeavor, really 50-50 chance whether or not you're going to receive the consideration in the agreement. If it's not probable, you have not met the element yet to have a contract, therefore you cannot recognize revenue yet. So for collectability, what we'd like to see some historical analysis of what is the likelihood of collection based on the type of customer, maybe specific experience with that customer, things like that is what you need to be taking into consideration for that element. So that's been the biggest time taken on the required elements of the contract. And at the end of the day, the whole point of this is that it needs to be a valid and genuine transaction between an entity and the customer. There should be enforceable rights and obligations, true economic consequences for it to fall under 606. If that's contribution, some other non-exchange, that has other standards that it falls under. Okay, so step 2, PO, performance obligation. So as you go through, you've determined we have a contract. So now we need to determine what are we performing for the client, the customer. So you will use the following criteria to go through and determine what are actual performance obligations. So the first criteria, capable of being distinct. So the customer can benefit either on its own or together with other resources readily available to the customer. And then the second criteria, distinct within the context of the contract, separately identifiable from other promises in the contract. So some examples we've seen of this is when you have maybe a product that you're selling and there's also installation that goes along with it. Depending on the facts and circumstances of that scenario, you could potentially have 2 performance obligations, the product and the installation, or there's the chance you only have 1 performance obligation because what you're doing with the installation is so integrated or modified, customized, that it can't be separated out. So when you're going through performance obligations, you have to take those things into consideration to determine how many do you really have, so you can try to figure out when to recognize revenue on each of those. And there's a couple key points to take away. If you can't, if it's not distinct, you can bundle them together, a good or service, until you have a distinct bundle that can be recognized. And then also, if multiple distinct, but they have the same measure of progress over time, they can be bundled as a series to make 1 performance obligation. too fast. Okay, continuing on with step 2 over performance obligations. One other thing that you need to take into consideration is the potential for implied promises within your contract. So depending on how you've historically interacted with a client or what services you've historically provided to them, they may be making the assumption that that is a service that is going to continue or will always be provided. So you may have these implicit promises within the contract, so it's not written in the agreement, but it is expected by the customer based on history or your policies, things like that. So one example are maintenance services. If you've historically provided those and you don't charge extra, the customer is going to expect that those are going to continue. So you may have a performance obligation related to that as well, even though it's not in your agreement. And there is some consideration on the materiality of a performance obligation in the context of the contract. So if it's something that's highly immaterial, it's such a tiny piece of the puzzle, you can take that into consideration and you don't have to do like an aggregation exercise over what the effect would be on the financials. Okay, moving on. So C3PO in his tar pit, T, transaction price. So the transaction price, your total consideration that the seller expects to be entitled, excluding amounts collected as the agent of a third party. So there's a couple key things that have come up or that you need to consider regarding the transaction price. So the first is you have variable consideration. So the examples, there's a couple given on here: discounts, rebates, concessions, bonuses, etc. You need to estimate how much the effect of that is going to be. And there's two different ways you can do this. You can either come up with a most likely amount, so single $1 amount, or you can come up with a range of possibilities and do a probability weighted average on those. So with the variable consideration, if significant reversal is probable, don't include it until that uncertainty is resolved. So you don't want to go back and forth, crossing periods, things like that. You need to recognize the impact of the time value of money, whether it's expense or interest revenue, if the difference between when the payment happens and the satisfaction of the obligation is greater than a year. And of course, there's exceptions to all of that. If part of the consideration that you are getting from the customer is non-cash, so they're not paying you money, there's something else going on, you would measure that at fair value. So you can look to the fair value guidance on different methods to be able to do that. And then one of the other fun key takeaways from the transaction price consideration is if you have consideration payable, so coupons, free product rebates, that kind of a thing, to the customer, there's different ways it could be treated depending on facts and circumstances. So that may either be a reduction in your transaction price or a distinct payment or both. So you need to look at each situation to see what is the most likely effect on that. Okay, moving on to step 4. Now we get to finally allocate that transaction price to each performance obligation based on a standalone selling price at contract inception. So there's some specific guidelines if you are going to be allocating discounts across performance obligations or entirely to one obligation. And then if there's any subsequent changes in your transaction price, then you would do those on the same basis as what it was at contract inception. And then moving on to the next slide has a couple more takeaways on this step, the allocation. So when it comes to figuring out the transaction price, the best evidence of a standalone selling price is obviously if you sell this thing by itself and not part of this maybe bundle that you've created, that is your best evidence of this is how much it costs to provide this good or service. But that's not always the case. There are times that, the product or service that you're providing is not sold separately. And so what do you do in those situations? So there's a couple different options for approaches on how to estimate, okay, I don't have this in my price book, but this is, you know, what it would be. So the first way that you can go about it is, hey, does somebody else sell this standalone? So you could look at, if you have a competitor or somewhere else in the market that this kind of a good or service is being sold, you can look to that, make reference to competitor pricing, and then adjust it for your own costs, margins, considerations. So let's say, okay, not something sold by somebody else. You could do a forecasted cost, so plus whatever your normal margin may be, whatever you deem to be appropriate. So try to figure out what would the cost be for me to provide this good or service. And then the last option is kind of like the back-end approach. So you have this bundle you're providing, and you know what, you know, say there's 4 products, you know what A, B, and C, what they would be on a standalone. You kind of back into, okay, if those are what they are standalone, this is the group price, what does D have to be? So a little bit of algebra could be used to back into the cost. So this would be your residual approach. And they told you you'd never use algebra as an adult, right? Okay, so our last step. So we finally made it through. We get to recognize some revenue. So you're going to recognize revenue when the obligations are satisfied because the customer has obtained control of the good or service. So control is they can now direct the use. They can substantially get all the benefits out of the asset or whatever is being provided. So this can happen, the timing of this can definitely be different depending on what you're providing. So you may have something that's satisfaction point in time. You delivered the product, the customer now has control of it, you're done. There may be other circumstances where really you're providing something over a period of time. So the revenue is getting recognized over a period of time as well. So kind of similar to a percentage of completion method, if you think about it from that perspective. So there's a couple more complexities that come into play when you're recognizing revenue over time. So here's some of the criteria for that type of recognition. So customer simultaneously receives and consumes the benefit provided. The seller performance creates or enhances an asset that the customer controls as it's being created or enhanced. So work in process. And then seller performance does not create an asset with an alternative use, and there's an enforceable right to payment for performance completed to date. So you are creating something so customized or modified for this client, nobody else is going to be able to use it. So if you had to stop on it, there's nobody else you can sell it to. And if it part of your contract is there's this enforceable right to payment as you're progressing, then you can be recognizing your revenue over time as you're working on that product or service. Even if it's not completed, you will be able to start recognizing revenue. So those are some of the things to take into consideration on the timing of revenue recognition. So when you're doing over a period of time, there's 2 different ways that you can go about this. You have your input method, where you're looking at, okay, what am I putting in to this product or service? So you're measuring it by your labor hours expended or your costs incurred. So really looking at it from your perspective of what you've put into this project. The other side, the output method, where it's coming at it from the customer side, where what have they received so far? So let's say you promised them 1,000 widgets, you've delivered 500. It's going to be based on the output, what you have provided to them so far. Okay, so that was a really quick, high-level recap of our 5-step model under the new revenue standard. Now, for every industry, every element, there are always exceptions to the rule, always. So if you have any questions on your particular circumstance, please feel free to reach out to us at Eide Bailey. We'd love to help you through those, because there's a lot more gray sometimes in determining this revenue recognition process. So now we're going to switch gears. We're going to start looking at some of the disclosures that will be in your financial statement. So now that we've implemented this standard, how does that affect your financial statements? What do you need to do differently? What information do you need to have available when you're going to prepare financial statements? So we're going to start, this is broken into two different elements. So we have some disclosures that are required, not getting out of them. Everybody's got to do them, whether you're public, private, doesn't matter. Then we have a set of disclosures that are required for public entities and optional for private or non-public. So if you just really want to go above and beyond and give those users of the financial statement as much information as possible, you can just have fun with those additional disclosures. So we will walk through those just so you kind of have an idea of what's out there. So the following are the disclosures that are not optional. So these are the ones you're putting in your financial statements. So you need to be separately recognizing revenue, credit losses, and impairment losses. So related to this revenue from customers, contracts with customers, those need to be separate from any other revenues and losses. So if before you had it all meshed together in your line items, you need to separate those out. They need to be separately listed on your financials. There needs to be a disclosure disaggregation of a revenue by timing or transfer. So that's where we were talking about you're either recognizing revenue at a point in time or over a period of time. So this is the disclosure that you would have for that in your financial statements. And it can be done a couple different ways. You can do a chart, a table that says, okay, this is the dollar amount of our revenue, point in time versus over time. Or if you want to do it in a narrative description, that is an option as well. So kind of preference on that presentation. The third is the opening and closing balances of contract assets and liabilities. And this is where you need to pay particular attention to what years are you presenting in your financial statements to determine what opening balance are you disclosing. So just there are different methods of application for this standard, whether it's retrospective or with a cumulative adjustment. So you may be doing dual year, single year presentation. Just as you are thinking about that, you need to make sure that you are properly disclosing the opening and closing balances of contract assets and liabilities. That's where the opening has sometimes gotten missed in disclosure. 4, you have some qualitative information about those performance obligations. So what types of performance obligations do you have? What are the significant payment terms? What's the typical timing of when those are satisfied, and any other pertinent information? And that's done qualitatively in the footnotes. And then this standard allowed for some different practical expedients. So for example, if you had completed contracts within the same period, you don't have to go back and take a look at those. So I think there were 4 different practical expedients. If you adopted any of those, then you need to disclose that in your financial statements. And most of the time, the practical expedients are making your life a little easier. So likely you're adopting some of those. Okay, so now we're moving on. So these are the disclosures optional for non-public entities, but required for public entities. And these are the ones that are both on an interim and annual basis for public. So a disaggregation of revenue to depict how the nature, amount, and uncertainty of revenue and cash flows are affected by economic factors. And you need to have sufficient information to understand the relationship between the disaggregated revenue and each segment's revenue information. So for example, types of good or service, geographical region, market, whatever the natural breakup of that revenue may be to disclose. 2, some information about contract assets and liabilities, including balance changes, the amount of revenue recognized in the current period that was previously recorded as a contract liability, and then the amount of recognized in the current period that is related to performance obligations satisfied in prior periods. So those things that are kind of crossing your time, your year presented. And number 3, information about the transaction price allocated to remaining performance obligations, including the disclosure of quantitative amounts, and then quantitative, qualitative explanation of when those are going to be recognized as revenue. And so here's one of the practical expedients you can meet if you've met the following criteria. So if it's part of a contract, duration of less than a year, and then if it's recognized in a manner consistent with the entity's right to invoice. So if those are the case, there's a practical expedient for you. So then switching, those are the ones required on an interim and annual basis if you're public. Now we're switching over, these are the ones that are just on the annual basis for public entities. Again, non-public, if you really just want to throw these in there, up to you. But first, explanation about significant changes in contract balances. So it's qualitative and quantitative information. Then qualitative information about the timing of performance obligations satisfied over time. So your methods of measuring progress, judgments made, and what is the transfer of control. And then for those satisfied at a point in time, were there any significant judgments about what the transfer actually consisted of? And then number 3, qualitative, quantitative information about determining the transaction price. So this is where that variable consideration comes in. If you had any non-cash consideration, any constraining estimates, how you allocated the transaction price, and then measuring your obligations for returns, refunds, all of that information in there. Number 4, information about the accounting for costs to obtain or fulfill a contract. So account balances by main asset category, amount of amortization and impairment losses, judgments made in determining the cost, amortization methods used, all of that fun stuff. Okay, so now that is our recap of 606. That was a lot of information. If you need examples of disclosures, want to kind of see what that might look like, reach out to your Eide Bailey representative. We have examples drafted up in many different industry lines of what the most common disclosures may look like for those. And then a good amount public companies have adopted, so that is always an option as well, as to look at industry-wide what has been normally being disclosed after the implementation of this standard. So now we're going to switch gears to another revenue related standard that will be effective for the current year. So for some of the nonprofits especially, this may have a significant effect depending on the contracts that you have in place. So ASU 2018-08, so clarifying the scope and accounting for contributions. So we have our dates here. So this is a two-pronged standard where a portion of it will be implemented at a different time than the other portion. So for our contribution recipients, you're the recipient of the contribution, whether it's a grant or some other kind of agreement. This is effective for periods beginning after December 15th, 2018. But now the contribution provider piece comes into play as well, where you will have that portion effective for non-public entities after December 15th, 2019. So the big picture takeaway from this standard is some clarification, especially when you have grant type agreements, on whether those are exchange, non-exchange, how they should be treated. So if the resource provider is receiving commensurate value in return, it's an exchange transaction. So the execution of a resource provider's mission or positive sentiment as a donor, that's not commensurate value, not the same thing. Doing it for the public good, not the same thing. It needs to have, again, kind of like we talked about with 606, economic substance. You're getting what you pay for, kind of a thing. So if the consideration received is not an exchange transaction, so it's falling under this standard, then it is a contribution where the revenue is immediately recognized, although it could be time or purpose restricted. So you may have, a restriction on your net assets depending on the time and purpose of whatever that contribution was for. but there is some caveats with whether or not there is a barrier that must be satisfied. And so if it is a conditional contribution where a barrier must be overcome, there could be a delay in your revenue recognition. So if you're encountering, relooking at some of your grant agreements, let us know if you need help determining whether or not there's a barrier that needs to be overcome that you need to take into consideration on when you can be recognizing revenue on that contract. So of course, as with most standards, COVID-19 has had an effect on revenue recognition. So we have already talked about ASU 2020-05 that delayed implementation of the standard. But now we're going to look at it from, let's say you have implemented or you're going to be implementing. What new things do you need to take into consideration potentially because COVID-19 has changed the economic landscape? So here's just a couple things that you may want to consider, you may need to change as you look at your contracts. So collectability of at-risk new contracts. If you have been entering into new contracts with a new customer base, maybe because of COVID-19, need to be evaluating what's the collectability of that. Are these new contracts riskier than your regular portfolio? Are there different considerations that you need to be taking into consideration when you're doing that step one, determining if you even have a contract? Also, so that's when you're looking at, okay, new customers, new contracts, things maybe we haven't gotten involved in before. What about your existing contracts, customers, accounts receivable? Have there been factors from COVID-19 that have changed their risk profile for you? Are you likely to receive the amount of consideration that you had originally expected? Are your accounts receivable realizable anymore? Those are things that COVID-19 may have an effect on depending on the type of customer base you have, the geographic location you're in, things like that. So you will need to do some evaluation on revenue recognition after the pandemic. There could be the potential for the impairment of contract costs or other contract assets. You may need to make some contract modifications, and there could be some significant changes in the variable consideration that you give now. Discounts, things like that could significantly have changed after this pandemic. So those are all just some elements to keep in mind. You probably spent a lot of time getting ready for revenue recognition before COVID-19 hit. And now some of that historical analysis that you did, especially in collectability, may have changed. So you may need to revisit that before year end to make sure, okay, are we recognizing revenue appropriately? Okay, now I'm going to pass it off to Kellen to teach us all about derivatives and hedging.
Thanks, thanks, Kristen. Yeah, we're going to start out by looking at some just other general updates that are applicable to non-public business entities this year. We're going to start by taking a look at ASU 2017-11. And 2017-11 deals with a few different things, but it's primarily related to down round features. And a little background for those of you who aren't familiar with a down round. Private companies typically go through multiple rounds of stock issuances to help finance their operations. And it's generally expected that each round of financing is going to close at a higher price than the prior rounds. However, that's not always the case. You think about an entity that closed on a round of financing at the end of 2019, and then another one in June 2020. Obviously, COVID happened during that period, and the equity market might have dried up a little bit. So maybe they closed at a lower price than in June than they would have in December. So when that happens, that's considered to be a down round. So a down round provision, it's an element of a financial instrument that's linked to equity. And these financial instruments could be an equity conversion feature that's embedded in a debt or equity contract, or it could also be freestanding. So here we're going to be thinking about instruments like convertible notes, convertible preferred stock, or warrants. And what the down round provision within these would do is it would adjust the strike price down if a new equity shares are issued at a lower price than the current strike price. So under GAAP, some equity contracts that were indexed to and classified in stockholders' equity received a scope exception from derivative accounting. But if a contract had that down round feature, it caused some of those contracts not to meet the scope exception. So as such, those contracts with the down round feature that met the definition of a derivative were required to be recorded at fair value, with the changes in fair value reported in earnings. Now, after the adoption of this standard, when determining if those certain financial instruments should be classified as a liability or an equity instrument, that down round feature doesn't preclude equity classification anymore. So what this ASU is doing is it's easing the accounting for these down round features for some entities. In addition to that, the ASU also amends some disclosure requirements and some of the earnings per share reporting requirements. Next up, we're going to take a look at ASU 2018-16. And this one is related to LIBOR. What it does is it adds another benchmark interest rate for hedge accounting purposes. And the reason we had to add this is because LIBOR has historically been one of the most widely used reference rates, but due to fraud and collusion concerns, it's expected to be phased out by the end of 2021. So with that phase out of LIBOR, some countries have adopted their own reference rate replacements. And in the US, the Federal Reserve has selected this secured overnight financing rate as its preferred replacement reference rate. And what this ASU is doing is it's adding the overnight index swap rate, which is based on SOFR, as an allowable benchmark for hedge accounting purposes. So now, instead of the 3 prior options for hedge benchmarking, we now have this new overnight index swap rate as another allowable option. All right, so let's take a look at some other ASUs that'll be applicable. This one kind of plays into the same line as ASU 2018-16 because it's also related to the phase out of LIBOR. So LIBOR has historically been one of the most widely used reference rates. I saw an article from Reuters that said there's $400 trillion worth of contracts that use LIBOR. So obviously it's going to have a huge impact on entities as we transition away from LIBOR and into other reference rates. Understanding this, FASB decided to issue some guidance on how companies should account for these changes in their contracts or in derivative or hedging relationships. So as kind of in general, GAAP requires entities to reassess contracts when there's changes in terms. And then you're going to do that to see if the modification results in establishment of a new contract or the continuation of the existing contract. So obviously there's going to be a lot of contracts that are going to be modified as a result of LIBOR. So this ASU provides several optional expedients to ease that transition away from LIBOR and into a different reference rate. At the bottom there, you'll see that the effective date's a little bit different than some of the other updates. It was effective upon issuance, so March 12, 2020, and then it continues through December 31st, 2022. There are a couple contracts that might be beyond the December 31st, 2022 date, but generally that's when it's going to end. A good thing to point out is that while LIBOR is going to be the most widely impacted reference rate, the standard actually applies to any other discontinued reference rates. So like I said, it deals with a couple different things: contract modifications, hedging, and then some investment items. We're going to start by talking about contract modifications a little bit. ASU provides some specific examples of contract modifications that could result from reference rate reform and provides optional expedients and exceptions for those. So they give specific examples for receivables, debt, leases, and embedded derivatives. So some of the big transaction classes that'll be affected. But what it also does is it provides some overall guidance for other contracts that weren't specifically discussed. And for those, it says generally the general principle is going to be that contract modifications due to reference rate reform do not require remeasurement or a reassessment of previous accounting determinations. So this is only going to apply to contract modifications that replace reference rates. So what that means is if we're changing other contract terms, even if they're changed at the same time as the reference rate, we still need to go through our normal assessment to see if those other contract modifications resulted the need to reassess contracts and determine if those modifications result in the establishment of a new contract or continuation of an existing contract. Also, if an entity elects any of the optional expedients for a contract modification, it has to apply those consistently to all eligible contract modifications or transactions within that topic. So what that means is if we have a debt agreement, a line of credit agreement that's reference LIBOR, and we update it, we apply the practical expedients, then we also have to apply those practical expedients to the rest of our debt agreements, since they all would be covered under topic 470 for debt. And then switching over here to kind of look at some of the hedging and investment items that are related to this update. We'll start by looking at the hedging, which is discussed in the first couple of bullets here. And the first bullet is in reference to critical terms within a hedge contract. So with ASU, certain changes in the critical terms of a hedging relationship do not result in de-designation of the hedging relationship, as long as certain criteria are met. For that second bullet, it's related to excluded components. And what the ASU allows is for changes to the systematic and rational method that a company uses to recognize the components that are excluded from the assessment of hedge effectiveness and earnings. There's also some other fair value hedge and cash flow hedge items where they provide optional expedients for. For hedging, unlike contract modifications, if an entity makes changes to one hedge, they don't have to do it across all hedge contracts though. So there's a little bit more flexibility there for hedges. That last bullet there, that's separate from hedging, and that's related to investments. And what that allows is for a one-time election to sell or transfer debt securities that are classified as held to maturity if they were affected by reference rate reform. If you elect that option, you're not required to sell or transfer all the qualifying debt securities, and that sale or transfer doesn't call into question your prior assessments that you had the ability and the intent to hold those investments to maturity. So it gives you some flexibility there. Next up, we're going to look at the definition of collections. And this is primarily related to not-for-profit entities. The collections here that we're talking about would be collections of art or other works like that. For this one, FASB became aware that the definition of collections within the codification didn't align with what the American Alliance of Museums is using. So they issued this to improve the codification by realigning those definitions. Another thing the update does is it expands some options that you have for deaccessioned items. So previously, the only option that entities had for a deaccessioned item would be to purchase another collection item. Now, another option that's been added is that you can use those funds for the direct care and preservation of existing collections. For this, FASB didn't provide a definition or certain criteria for what the direct care and preservation is. But what they did was they said entities need to disclose their definition of direct care and preservation in their financial statements. So that'll allow the reader of those financial statements to understand what the entity's policy is. And then as before, entities still have those three options for capitalizing or not capitalizing collections, where they can capitalize them, they could capitalize them from a set date, or they have the option to not capitalize them at all. So now we're going to take a look at ASU 2018-17, which is consolidation. And what this ASU does is make targeted improvements to the consolidation topic as it relates to variable interest entities. So this is going to apply to legal entities that are under common control of a reporting entity and are being evaluated for consolidation under the VIE guidance. A couple key things here: none of the entities can be a public business entity or under the common control of a public business entity. And then this is going to, if you adopt this, it's going to apply to all the current and future legal entities under common control. But what this ASU will do is it'll increase the chances that you don't have to consolidate this legal entity. So if we adopt this, FASB has said that we do need to increase some disclosures so that the financial statement readers can still understand what the reporting entity's involvement with that legal entity is and what exposures are related to that legal entity. So a little background on variable interest entities. The original VIE guidance required entities to consider if common control entities should be consolidated, even if the reporting entity didn't have the majority of the voting stock. And then in 2014, FASB issued ASU 2014-07, and what that did was added relief to private companies that had leasing relationships with entities under common control. So this would be an example where a business owner has an operating entity and she also has a building entity, and was evaluating whether that operating entity needed to consolidate the leasing entity since it was under common control. So 2014-7 provided some exceptions from needing to consolidate those. And what this new update, ASU 2018-17, is doing is it's going to supersede and expand that relief that's provided to private companies. So here we've got the criteria that's required for us to be able to adopt this updated VIE model and potentially not consolidate some of these entities. The reporting entity and the legal entity need to be under common control, and we'll discuss what that common control looks like in a minute. The reporting entity and the legal entity cannot be under the common control of a public business entity. The legal entity can't be a public business entity. And the reporting entity cannot have directly or indirectly have the controlling financial interest in the legal entity when considering the voting interest. So what that last one means is that the reporting entity can't have voting control over the legal entity that's being evaluated. If the reporting entity has that voting control, you still need to go through and consolidate. So when we're looking at that first criteria from the other slide, the reporting entity and the legal entity are under common control. We should only be considering the direct and indirect voting interest. So in other words, the VIE portions of the consolidation topic should not be considered for that evaluation. So another thing that the update does is it updates some guidance related to decision maker fees and how they relate to the variable interest entity evaluation. What the update does is it makes it less likely that a decision maker applying this update would be required to apply the VIE model because fewer fee arrangements would qualify as variable interest. And we've got an example here of what the calculation looks like using this indirect interest model. So in our example, we've got a decision maker who owns 20% in a related party, and then that related party owns 40% in a legal entity that's being evaluated for consolidation. To calculate the reporting entity's indirect interest, we'd multiply their 20% interest in the related party times the 40% interest in the legal entity, and we come up with an 8% indirect interest. So in this situation, that 8% would generally not be considered significant because it's under 10%. So if an entity adopts this ASU, what do the reporting requirements look like? Well, we said, okay, you won't have to consolidate, but you do need to provide some guidance for the financial statement reader to understand what that relationship looks like. So you're going to disclose what the nature and risk associated with that legal entity are, the effects on the financial position, financial performance, and cash flows due to involvement with the legal entity, what the carrying amounts and classifications of assets and liabilities recognized in the balance sheet are due to our involvement with the legal entity. And then we also need to disclose what our maximum exposure to losses are. If we don't know what the maximum exposure is, if we can't quantify that, we do need to disclose that fact in the financial statements. Also, if the maximum exposure to losses exceeds the carrying amount of the assets and liabilities recognized, then we need to provide some qualitative and quantitative information related to that so that the financial statement reader understands what that excess exposure is. A couple of other disclosure items to be considered here. The reporting entity also needs to consider any financial exposures through implicit guarantees. And then also the reporting entity needs to follow any other disclosures that would already be required under GAAP. So related items might be guarantees, related party transactions, and leases. So let's say that the reporting entity has gone through the evaluation. They used the practical expedients for this, the private company alternative for this. And then several years down the road, the criteria in the ASU stopped being met. So that reporting entity would apply the normal VIE guidance. So you're probably going to end up consolidating that legal entity. And you're going to do that on a prospective basis. But if the reporting entity becomes a public business entity, we're going to treat it a little bit different by, instead of treating it on a prospective basis, we're going to have to go back and apply it retrospectively. And we're going to do that because this guidance is related to private entities and it isn't related to public business entities. It's a private company alternative. All right. So next we're going to talk about ASU 2018-07, which is stock compensation for non-employees. And this is part of the FASB simplification initiative. They had priorly updated the accounting for employee share-based payments in ASU 2016-09. So what this update does is it eliminates the prior guidance for stock compensation to non-employees, and it merges that guidance with what we're doing for stock-based compensation paid to employees. So it gets rid of some of the divergence there. We got three key parts of this here. The overall measurement objective is going to be to measure these non-employee share-based payment awards at the grant date fair value of that equity instrument. We're going to do that when the good or service has been delivered or rendered and other conditions have been satisfied. One thing to remember for awards with performance conditions is that the entity needs to consider the probability of satisfying those conditions when it's estimating the expense. And then for our measurement date, we're going to be using the grant date. And the grant date is going to be the date at which the grantor and the grantee reach a mutual understanding of the key terms and conditions. And a few other elements to ASU 2018-07 are the classification reassessments for certain equity classified awards. So generally, this ASU is going to eliminate the requirement to reassess classification of these awards upon vesting. Also for intrinsic value, there's an update here that's applicable to non-public entities. Under prior GAAP, these awards would be measured at fair value, but this provides a one-time election to switch from measuring at fair value to measuring at intrinsic value. Once again, that's applicable to non-public entities. And then another item here would be the calculated value, which is also applicable to non-public entities. So the prior GAAP, the inputs into the valuation of the equity share options and similar instruments issued to non-employees included an estimate of expected volatility. But now entities are able to use historical volatility of an appropriate industry sector index. All right, so let's take a look here at ASU 2017-08, which is related to non-refundable fees and other costs, and the premium amortization. So under current GAAP, entities are generally required to amortize the premium on a callable debt security as an adjustment to the yield. You're going to do that over the contractual life, so to maturity of that instrument. So what this would result in is if the debt was called early, the entities would have this unamortized premium, and it would be recorded as a loss in earnings upon the debtor's exercise of a call. But after adoption of this ASU, it changes it to where entities are going to amortize that premium to the earliest call date. So that's going to eliminate these losses that had been recognized in earnings in prior year before the ASU had been adopted. The ASU just deals with premiums though. So if you've got any discount on debt securities, those will continue to be amortized as an adjustment to the yield over the contractual life, so through maturity for that investment. Another update we have here is ASU 2019-08. And this is kind of related to ASU 2018-7 or 2018-07, which we talked about a minute ago. Certain provisions under prior GAAP were amended to require that share-based payment awards granted to a customer in conjunction with selling goods or services were supposed to be accounted for under topic 606, which is revenue from contracts with customers. But while 606 provided guidance on the presentation of these transactions, and that presentation was a reduction of the transaction price, so therefore a reduction of revenue, the 606 guidance didn't provide any guidance on measuring those share-based payment awards granted to a customer. So FASB issued this ASU to provide guidance on how to measure the share-based payment awards granted to a customer. So now entities are required to use a fair value-based measure to calculate these incentives, and you're going to calculate that on the grant date. And that grant date is going to be the date that the grantor and the grantee reach that mutual understanding of the key terms and elements of the share-based consideration. The result of this is going to be a reduction of revenue. And then after initial recognition, the measurement and classification of the share-based sales incentives continues to be covered under topic 718 unless the award is subsequently modified when it's vested, and if the grantee is no longer a customer. And then here we've got the summary of the effective dates related to this update. You'll notice that the effective dates depend on what private companies have done with ASU 2018-07. So it's going to be, you're going to want to make sure that you've got those aligned and that you're getting everything adopted correctly. All right. And then we've got another polling question here, which is going to transition us into our next topic that Scott's going to be talking about. The question is, does your entity have a PPP loan? Yes or no?
All
Thanks,
right. Go ahead and answer that. And Scott, you now have control.
Okay. All right. So we've been working a lot with organizations that have had these CARES Act loans, through the COVID environment. And it's been interesting. There's been a lot of interpretative guidance, I'll say, that's come out about this, particularly as it relates to commercial entities and then not-for-profits. And the guidance is a little bit different for both those, but there are, I'll say, guidance opportunities. As I look at this first slide, I'm going to talk a little bit about kind of what's going on and why there's a lack of guidance and maybe where that gap gets filled. As these loans were extended, they are actually loans. The promissory notes, signed agreement, there's a repayment terms, interest rates, and all those things that go along with indebtedness. But the thing that was unique about them is they built in this forgivable component. So when it comes to actually taking out debt, having a promissory note, ASC 470 covers that topic, and provides accounting guidance just like you would with any other debt instrument. The thing that's unique is with this built-in forgivable piece, there's no guidance in FASB, at least as it relates to commercial entities, that specifically covers what happens when you have a forgivable loan or some sort of, they call it an in-substance grant, or however else you might view it. So that's the piece where there's a lack of guidance that opens up some question as to, what is the proper accounting here? We've been recommending to agencies to follow 470. That's, where we feel the guidance is probably the most guidance-based approach. But let's talk a little bit about kind of the pros and cons, or the difficulty in applying that guidance. Under 470, you would record that as debt, as a loan. And then the question is, okay, at what point in time, if the forgiveness is achieved, at what point would you record the forgiveness? Well, ASC 470 doesn't cover forgiveness, but ASC 405, extinguishment of debt, does cover forgiveness. And in that case, it says that forgiveness is given when basically the entity is legally released. And the entity is not legally released until the SBA gives the final approval. In the next couple of slides, I'll go through them, and they've got some timelines in there and some, expectations for kind of the requirement of that. But what that means is that until the SBA gives that final approval, you would not record any forgiveness. So people are incurring the cost this year. They obtain the loan to help subsidize those costs, mostly payroll, but utilities, mortgage, rent payments. There are some limitations in some of those. That's primarily what they're being used for. That's primarily what we're seeing is we're helping people through the application process. That's primarily what we're seeing is mostly payroll, but there are some other, like I said, utilities, mortgage payments, leases, rent, those types of things are allowed. And so as we go through this guidance, we record them at using 470, call them a lease. This forgiveness portion, again, has caused kind of a bit of a wrench. But if we follow 470, we record as a loan, we follow 405, and then we'll wait for the SBA to give their legal release on that. And that's what we think, is probably the most appropriate guidance-based approach. But given that, that forgiveness piece, if some people view that as an in-substance grant, the guidance doesn't cover that, except for nonprofits. We'll talk about nonprofits in a minute, but the guidance doesn't cover that. So to the extent that somebody is looking to accelerate that forgiveness, certainly if your entity is looking to accelerate the forgiveness ahead of when the SBA gives the final approval, then you want to document your approach, your guidance-based approach of what guidance you think is appropriate. In the case of not-for-profits, 958-605, it talks about refundable advances. And so that's the guidance that a lot of, non-authoritative literature is reaching out and saying, well, we think that maybe that's the most appropriate guidance place in terms of how we're going to record, revenue, at what point we recognize the revenue. And in that case, there's a couple of criteria to consider. The first one is, when have you substantially met the condition to receive the forgiveness? And so that's a key factor, especially when we're talking about 630 year ends or 731 or 831 year ends. That's a key component, because as you evaluate, when did you substantially complete the condition, substantially meet those requirements? If you selected the 8-week period and the 8-week period was completed before, say your June 30 year end, and the 8-week period went from, April 15th to say June 15th. Well, you potentially substantially completed the conditions. And again, those conditions were maintaining the FTE count for a certain period of time, maintaining FTE pay. It has to be at least 75% of what they were getting paid. And so there's certain limitations, or a piece that's not forgivable if you didn't maintain the pay at the rate that they were at before COVID impacted your pay rates. And so there's certain criteria that you would have to maintain. And if you didn't complete that, or if you completed that, again, in my example, if you chose the 8-week period, and you went from 4/15 to 6/15, then in your June 30 year end, that potentially you substantially completed that condition. And that opens up an opportunity to determine whether or not, you could recognize forgiveness in advance of the SBA giving their approval that they agree that they're officially giving you the legal release. So we've had both for-profit entities that are looking at the 958 guidance, although they're not not-for-profit entities. They still look at that guidance saying, well, given the gap that's in the guidance related to this forgivable piece, would that be an option for us to employ? So that's something to consider. What happens is that, you know, in the case of the entities, and I was working with one just this last week, where the entity had selected the 24-week period, their June 30 year end, and so they crossed their period went from, it ended sometime in the mid-September timeframe, and so they didn't substantially complete that that condition to maintain the FTE count for a period of time, you know, until after year end. Now, they did complete it after year end, and so there's an opportunity for hindsight, but according to the guidance, you can't forecast that they would be in compliance and then record forgiveness today, or recognize revenue today, because they didn't meet the condition until after year end. In other words, they didn't, you know, using kind of a term that Kristen was using earlier, you know, I'll use a revenue term, performance obligation. They had an obligation. While this isn't an exchange transaction, they still had an obligation to maintain FTE count for a period of time. And in this case, in the case of an example of the entity I was working with, they didn't complete that obligation until the middle of September. And they didn't maintain their FTE count until, you know, from July 1st through the middle of September for 2.5 months. They still had obligations that they had to make, to meet. And so that's where, okay, well, how much did they substantially meet at year end? And there can be some prorated considerations for that, but the guidance isn't so clear that you can just recognize whatever you had expensed up to that point in time. In one non-authoritative piece of guidance that came out about 2 weeks ago, they gave an illustration. And they said, well, let's say, and I'll simplify the illustration. Let's say that you got a loan for $1 million, and that $1 million piece is less significant to this calculation. Let's say by June 30, you'd met halfway, you'd selected the 24-week period, you're 12 weeks into it at June 30, or at your year end. And let's say you had spent $700,000. Well, because you're only halfway through your conditional period, you can only recognize half of what you spent, because otherwise the rest is subject to recapture, or you're not going to perform on that by employing those people until the rest of the year. So you would actually be able to recognize $350,000, half the $700,000 that you had spent. So again, kind of some unique pieces there to try and navigate in this case. So the two pieces of guidance that people are trying to follow are, again, ASC 470, in which then you would record as a loan, and then following 405, which means that you would recognize the forgiveness when you're legally released being by the SBA. And that's applicable to both commercial entities as well as not-for-profits. The second way is to follow 958, which is available to not-for-profits, but still you have to determine when you've substantially met that condition, which in many cases of people, it's like the 24 weeks might happen after year end if you're a June 30 year end. Or again, some for-profit entities are evaluating whether or not that's an option to apply that guide to, given, again, a gap, you know, or a lack of guidance in FASB as it relates to the forgivable piece. So again, that's kind of in some uncharted territory to some degree. The FASB has talked about this issue. It doesn't seem like they're inclined to issue standards related to this particular issue. You know, the international standards also have ISA 20 that talks about grants in the commercial space. So that's again, if you're going to make the case that there's a lack of authoritative guidance related to that forgivable option, that's also an area where you go to, and there's a couple of different components and the way you can recognize it there. That normally I've only seen the ISA guidance applied in you know, what I'll call US GAAP. Usually there's like an energy company that's receiving some subsidies or something like that. So there's some guidance there. But so those are some of the struggles and the difficulty in coming up with this. I'm going to go through this next couple slides, talk a little bit about the timeline to kind of reinforce what some of this looks like. You know, if your fiscal year end is 12/31, hopefully you've been able to go through that 8-week or that 24-week period before your year end. But we've been working a lot with off year ends that have 7/31 and 8/31 year ends that are looking at this guides to try and figure out what's the most appropriate for them. One thing, you know, as we look at this guidance, you know, it talks about, initially they had, you know, most of these loan agreements were written, or these promissory notes were written with a 6-month repayment period. Later that was extended, and then there was kind of then there was a 10-month period. One question that's come up quite a bit is, well, at what point do we recognize this as, is this current? Is this a current loan, or is this a long-term liability? Or if, in the case of non-for-profit, if you chose instead of the loan guidance, the refundable advance guidance, still you have the same question: is this short-term or long-term? And again, non-authoritative guidance would suggest that there's actually not a lot of authoritative guidance on how you define long-term versus short-term. But normally it's what you would expect to redeem in the next year. And so following that logic, you would actually, if you expect the full amount to be forgiven or some portion to be forgiven within the next fiscal year, that's the amount that you should record as short-term. Now that's led to some issues as it relates to organizations working through any debt covenants. If they call that a current liability, then certainly there's some factors to consider whether or not, if you've got debt covenants related to current ratio or debt to equity, or any other sort of debt related ratios, having the full thing written as a loan and potentially some portion or even the whole thing as current could cause some issues in that area. So that'll be something that you'll want to be talking to your lenders about. If you determine that, hey, this isn't going to be forgiven, or some portion is not going to be forgiven, then that portion, as you're looking at current versus long-term, you would follow whatever the amortization schedule is based on, again, the latest guidance is a 10-month deferral period before you start making payments. One thing that I want to talk a little bit about is what this forgiveness process looks like. In the next couple of slides, and I'm just going to kind of cover them now and just kind of talk kind of seamlessly about this, but the lenders, when they extended these loans, they've received the funding, from the SBA or from the federal government, and then they extended these loans out. The first step of the forgiveness is to fill out an application that actually goes to the lender. And the lender goes through that application, and it has several criteria. I've looked at a handful of these applications, and basically, what did you spend the money on? So let's diagnose exactly what you spent the money on. There are some limitations as it relates to, you can't be paying somebody. There's a recapture if you paid somebody less than 75% of what they're earning, or there's a cap. You can't earn, if somebody was earning more than 100,000, then it caps out there. So there's different criteria that they're asked and evaluated as part of that. But how much of it went for payroll? At least 60% needs to be used for payroll. And then, did you use some for rent, utilities, some of these other types of things. For related party transactions, there's also some limitations. So the application goes through that process, and if somebody completes that application, they submit it to the lender reviews it. And after the lender has, I think, let's see, we've got a slide coming up here. The lender has 60 days to review it. They're at 0.7. So they got 60 days to review it. And once they review it, what we've been seeing from the lenders is they will give it, this is my terminology, but an acknowledgement that they've reviewed the application and then they've submitted it to the SBA. So coming back to the accounting guidance, we wouldn't consider that a legal release because the lender's actually not giving you a legal release. And from a lender perspective, from the banking world, there's been, the AICPA has put out some TQAs that talk about this, and they've actually said that they believe that the lender should keep that receivable, from the entity, receivable from you. It's a liability on your side, it's a loan on your side, but it's a loan receivable on their side. So that they should retain that on their books until the SBA is given the final green light, the final approval of that. So again, my terminology being an acknowledgement, and the acknowledgements that we've seen from the SBA, it's just saying we received it, reviewed your application, and basically saying they're not necessarily saying, hey, we believe that you've met all the criteria, although they're basically in fact saying that by saying that they submitted to the SBA, but they've submitted to the SBA, but we wouldn't consider that a legal release. Coming back to, if you're following guidance of 470, then 405 with extinguishment debt, we wouldn't consider the following of 405 the legal release requirement. We wouldn't necessarily consider that to be when the lenders acknowledge that they've reviewed the application and have accepted it. Rather, we think that's when the SBA is the one, because they're ultimately the one giving that legal release. Now, the SBA has 90 days to turn that around according to their guidelines. Whether or not they meet that, we've seen a lot of applications come through that have been turned around by the lender within the 60-day requirement, submitted to the SBA. Have not seen a lot of SBA approval come through yet, so we're not sure exactly if they're going to meet their timeline expectations or if that'll lag. Hopefully, they'll meet their expectations, and to the extent you're at 12/31 year end, if the application was done in time, maybe you'll have that legal release before year end, and this will be kind of a non-issue. To the extent that legal release extends because the application wasn't done, or perhaps because the SBA is behind and isn't keeping up with their 90-day requirement, which is a possibility. Again, we would expect that legal release to be that recognition date. If you're following 958-605, where you say, well, once we think we've substantially met the condition, which again would be at the end of the 24-week period, the 8-week period, with some proration opportunity, then you're not necessarily tied to that legal release the same way, although there's a couple of considerations there. Some of the there's mixed non-authoritative guidance talking about this. Some says, once you're at the point where you're just going through the application process, both with the lender and the SBA, if you view that to only be an administrative barrier, just an application process, then you believe you substantially met the condition at the end of the 8 or the 24-week period. Others are saying, no, we think that actually, given this application process, we think that's more than an administrative barrier. In that case, then you would be back similar to the 405 guidance. You'd be looking at the legal release of the SBA. So a couple of interpretations, some non-authoritative guidance to talk about kind of both sides of that. So something that you definitely want to be, reaching out to your auditor and talking with them and determining what you think the most appropriate guidance is. I think we've kind of covered all these other points. Going to that last bullet point, there's been some question of, well, if you're over the $2 million amount, and so you potentially have an audit obligation, would you have to defer recognition until that happens? Right now, our position is no. We believe that once the SBA is given the legal release, that would be the time that you would recognize revenue, or potentially sooner based on some of the other conversations that I've had or the dialogue that I've given. But we don't think that the fact that they may come in and audit that, certainly they're subject to some recapture if they disagree with anything, but we don't believe that their requirement for an audit of those dollar amounts of, over $2 million loans in of itself would be something more than an administrative barrier, or that it would, be something that we think would differentiate from you already having the opportunity to take advantage of the recognition through the legal release. We think the SBA will give a legal release, recognition takes place, and then they may come in and review that. And if they disagree, then there would potentially be a recapture at a later date. But we don't think that the recognition has to be deferred until that audit takes place. That's just a separate administrative function, on their end, but we don't necessarily think that's connected to the legal release. Again, although subject to whatever they find, there'd be some accounting considerations if they determine that some of it should not have been forgiven. But again, we don't think that would limit you from doing a recognition today. So here's just kind of a scenario. I'm not going to go through this in detail, but just again articulates, what that timeline looks like under an 8-week period and a 24-week period. All this, contingent on how quickly you get your application done. There's less limitation. There's limitations on, or requirements, I should say, on the lender to turn it around in 60 days and the SBA in 90. But there are no, but the limitations in terms of how quickly you get your application done are less so. You've got kind of a longer stretch or period in which to do the application. So I would, recommend that once you're through your 8 or 24-week period, to do the application as soon as possible, so that you don't end up, kind of in the back of the hopper as the SBA potentially gets backlogged on, a lot of volume coming in at the same time. But again, this gives you kind of some scenario that, what that might look like under the different cases. We had one question come up: what do you consider an affiliate for a PPP loan? There is some guidance in that when it comes to affiliates, there are limitations. You might have you might have, I mean, I would probably look at any sort of related party, anything under common control. Those are the types of things that I would probably look for in terms of whether or not it meets the definition of an affiliate. When it comes to affiliates, that's certainly a consideration when you're doing your application. If there's common ownership with, say, 3 different organizations, each one of those eligible to receive their own loan or their own repayment and their own criteria of 8-week versus 24-week, those types of things. One thing, there are some limitations if you have people working across those entities. They could get reimbursed from the PPP loan by those different entities, but still subject to limitations overall. So for example, again, earlier I mentioned that if somebody's making over $100,000, then they're limited, they're capped out at being reimbursed up to $100,000. Well, if they work for 3 different entities, the collective group of those entities have to add that up and say, well, we can't reimburse them for more than $100,000 for this individual. Now that could get allocated to the different entities, but those are some of the considerations when you're talking about affiliates and entities under common control. So as you're looking at your clients, looking for forgiveness, looking for whether they elected 8-week versus 24-week, whether or not they met the eligibility criteria, those are some of the considerations that, you need to take into consideration, make sure as you're filling out your applications that you're doing it appropriately, but then also, as your auditor comes in, you start to work with your auditor, they're going to want to make sure that, you weren't claiming more than you were allowed to be forgiven for, in which case you'd have to pay those funds back. Well, thank you. Appreciate that. That wraps up our presentation for today, and we look forward to talking to you again on our next presentation. There's a contact information, so if you have any questions, feel free to reach out to us or any other Eide Bailey person you work with. If there was a question we didn't answer, or you have a more specific scenario, we're happy to reach out and have talk about individual fact patterns.
Awesome. All right. Well, looks like you get a few minutes back in your day. So thank you so much to our presenters and to all our attendees. Hope everyone has a great day.